Well, good morning, traders and investors. My name is Roger Scott, and today is Tuesday. It is the 30th of March. Tomorrow is going to be the last trading day of March. It's going to be a Wednesday, and remember, we have a fragmented week. We have a holiday week this Friday. The markets are closed. Now, looking at the market, which is going to open up in about an hour and 20 minutes or so, you could see here that the NASDAQ is down about 100 points. It was down about 100 points. Now it's 95. It's fluctuating. But compared to the other sectors, it's not really doing too much. Now, the bond market is going to open up about 0.5, about 0.5% down. Looks like it's coming back down. Remember what I told you? These upside moves are not going to last very long because the market is headed lower. Interest rates are headed higher. Remember, there's an inverse relationship between interest rates and the bond market. So as yield goes up, bonds go down, which is causing the NASDAQ to cool off. The NASDAQ is still trading below the 50-day moving average. That's the 200-day moving average. That's the 50-day moving average. And we're right in between. So let's talk about global economy. And remember, this is a fragmented week. Why is this a fragmented week? Let me show you why this is a fragmented week. It is a fragmented week because Friday the markets are closed because we have Good Friday. And we do have employment data. We do have jobless claims. We have a lot of manufacturing and construction data. We're gonna have a good idea of where we stand in terms of manufacturing by the end of this week, and we're gonna see if jobless claims are picking up or not. But whenever we have a fragmented week, which means a week where any day of the week is closed, you're going to see a little. You're not going to see volatility expand itself or the market naturally give its rhythm like it usually does because a lot of institutional traders are out for the week. Whenever you have a week with a day off, it always messes up the work week. Now, let's talk about global economy and then I'll go through the sectors. So global shares were mostly higher on Tuesday. Nothing crazy going on except for that Suez Canal. One cause for optimism was the reopening of the Suez Canal, one of the world's most vital waterways, after a stuck cargo ship was freed. Thank God for small favors. At least 113 of over 420 vessels that have been waiting for the Ever Given to be freed were expected to cross the canal by Tuesday. There's going to be a 10-day delay, but again, 10 days is not a year, or it's 2 work weeks. It's not going to be crazy. So I'm not expecting this to have a major impact on the economy. Again, COVID-19 vaccines are rolling out. They're rolling out across the U.S. and they're being given to in Europe as well. One major issue is Japan. Japan's an exception. Only less than 1% of the population has been inoculated, which is not really that great. And there is rising worry that we're going to see more infections, but in Japan. But again, let's see how things go. They've been doing a pretty good job of keeping their public away from other countries and so forth. So let's see where that goes. I wouldn't put too much emphasis on that as of yet. Rising inflation. There is a fear of rising inflation, as you could see here. Lower bonds, higher yield. So that is a major factor with 10-year treasuries rising to 1.76. And again, I think we're going to end this year. With interest rates being near 2.5%, which would put us right at the 111 area or so, 112 area, 115 area, right in this ballpark. And I think that's where bonds are going. And if you look on a weekly basis, this is a weekly basis, we're clipping the 200-day moving average. On a daily basis, we're not doing really great either. And as you could see here, these pullbacks are very shallow. Notice, very shallow. Whenever you see shallow pullbacks, that means the trend is intact. I don't like deep pullbacks. I like very shallow pullbacks because that's telling me that the trend will revert itself. And this is the main trend right here. It's going lower, and these are the short-term trends. And remember, the market always reverts to the long-term trend unless there is no trend. So the bond market has me a little bit concerned right now. The market's looking for Friday's job report, as I have mentioned, which economists expect to reflect a big acceleration in hiring. There's a good reason for that, because if you look at the jobless claim last week on Thursday, you will see that the numbers were actually, we broke 700,000. We're at like 684,000, which is like the first time since the COVID started that we've broken the 700 level, or maybe the second time. But if we can keep breaking below the moving average, which is 736, we will do very, very well. So let's keep an eye on the jobless claims and the report. On Wednesday, which is tomorrow, Joe Biden will also give details about his proposal for rebuilding roads, bridges, and other infrastructures, which is why basic material and industrial stocks have been rising. Shares of raw material producers have rallied. Folks, I've been talking about that for months now. On expectations of heavier spending on such projects, even though many presidential administrations have failed to make it happen. I think we are going to see it happen, and this is the time for basic materials to rise. Now, let's look at major sectors. I want you to see something interesting. Look at industrial. Look at how good industrial is holding up. Look at that. Isn't that great? Look at basic materials. Look at how well it's holding up. But look at technology. Look at that. Sideways. No trend. No trend, right? Look at energy. Not really a big trend here. Financial looks like it could be pulling back. But here's what you need to pay attention to. And also look at consumer discretionary. It's like a triangle. Nothing. Nothing for consumer discretionary. Nothing for technology. But look at basic materials, right? Look at industrial. Look at these two. Look at these trends. Look at that. Look at that. That's a 1-year high. Can you say 2-year high in industrial stocks? How about basic materials? Can you spell 2-year high? I like that. Now, here's something else you should pay attention to. We're seeing breakouts in consumer staples, and we're seeing a breakout in utilities. Now, this is look at this. We are now finally, this is last February, so we're going higher, but we're still pretty much congesting long-term on utilities, whereas materials and industrial are going higher. And if you look at utilities, which we'll look at in a second, I'll bet you they'll look very similar to consumer staples. See, that's the February level. So although they look good if you're looking at them right here, they look like they're breaking higher. If you look longer term, they're really not doing that great. Neither consumer staples nor utilities, but they're going higher. They are going higher, whereas technology and consumer discretionary are not. So if you want the best sectors to be in right now, I'm going to tell you it's industrial and basic materials, followed by financial and energy. Then you've got consumer, then you've got real estate. Real estate is doing really well right now. I like real estate. But again, real estate is not higher than February prices. So make sure you're looking at sectors that are trading above the February high. And those sectors are industrial and basic materials. Let's look at healthcare. Yeah, healthcare is also up there, but not as high. So I would focus on industrial and basic materials. And I would not focus on technology or consumer discretionary. Look at that. Just congesting, highs, congesting. I don't like this congestion. I like breakouts. And on that note, let me show you something scary. About a year ago, remember me recommending Datadog? That was a top stay-at-home stock, Datadog, security stock, 90-day breakdown. Remember the number one stock during the stay-at-home environment, Zoom, 90-day breakdown. Oh yeah, that's how it is. Remember Teladoc, 90-day breakdown. You guys seeing what I'm seeing here? Remember Coupa Software, 90-day breakdown. Everything that we loved, loved, is now breaking down. But more specifically, look at this. I mean, look at this. Datadog, Teladoc, Zoom, Invite. These were some of my top stocks. So what is this saying? The stay-at-home economy is crumbling. That's right. Datadog, 90-day breakdown. Plan, down. But the biggest ones, this is the biggest ones, Zoom, Datadog, TDoc. Those were some of my top stocks for the stay-at-home environment a year ago. I mean, I remember, look at this, look at Teladoc. Look at this thing. Whew. And then breaking down. So again, breakdowns on the top stay-at-home stocks. That's what I wanted you guys to see that. Datadog, TDoc, Zoom. Literally, like these three stocks were in my top 5. They were. So keep your eye on more downside in tech and consumer discretionary and more upside in industrial and basic material. And keep your eye on utilities and consumer staples, because if interest rates go higher, we may see higher prices because of inflation on consumer staples, because those are things we need. Now, before I let you go, I got something important for you, really important for you. We know you guys have heard about GameStop. I know you guys have heard about GameStop. By now, my mother has heard about GameStop. And its sudden meteoric rise and its 4,200% returns amid a massive short squeeze. You guys have heard of GameStop. It's been all over the news. But what you probably haven't heard is that it's not the only stock getting squeezed. Nope, it's not. Wall Street doesn't want you to know about these massive moves because the big firms lose money whenever a short squeeze happens. Think about it. They have positions, short squeeze happens, they lose money because they're the ones that are short. They don't want anyone rising those stocks up. They want to stay short. And mastermind trader and Forbes contributor Adam Sarhan, he's pulling back the curtain back to reveal how you can take advantage of these trades every single week. Imagine him calling out stocks like GameStop, stocks that have gone up 4,200% plus. He's going to expose these short squeeze opportunities for you. Man, big banks are not going to love this. All you've got to do is click on the link below to learn how you can take advantage of these trades for yourself. You don't want to miss this. Folks, stop getting squeezed and learn about stocks that are getting squeezed by pro traders so you can uncover those same stocks and you can ride them up similar to GameStop. You don't want to miss this. Get in on these short squeezes. These are amazing opportunities. Just click on the link below. Learn how you can take advantage of these trades yourself. And make sure to like this video if you're watching on YouTube. Subscribe to this channel. Stay ahead of the market by being the first to be notified when we post new videos. And have a great day. And don't miss out. Adam Sarhan, Forbes contributor, mastermind trader. This guy knows his stuff. This guy's an industry insider. Check this out. Follow the link below. And have an amazing day.